Thank you so much, and welcome everyone to today's session. Today's session, Advanced Financial Statement Analysis. If you haven't done so already, I would encourage you to print out the PowerPoint slides. As we go through the material, I'm going to recommend that you take notes right on the slides themselves. With that, let's just move forward into the material. Page number 2, you can see, is my bio, which our administrator already has gone through. Bottom left-hand side of the screen on page number 2, you'll notice is my email address. If you would highlight or circle my email address, dlosborn@cox.net. If there are questions during the session, as I mentioned, or was mentioned, we will have a Q&A session at the end of the webinar. But I find that oftentimes it's a week from now, a month from now, 6 months from now, and you have a question. You're analyzing a financial statement. Don't hesitate to send me an email, dlosborn with the URN @cox.net. I want to emphasize 2 items. Number 1, I keep everything completely confidential. And number 2, I don't charge for this. I work with a lot of commercial lenders. I train the bankers, the CPAs, credit managers, and other groups. And I would work with you. Please just don't hesitate. Send me an email. With that, let's move forward into our material for today. Page number 3. 4 financial statements, just some basic review of the basic accounting, if you will. Income statement, as you can see, statement of retained earnings, balance sheet, and the statement of cash flows. The income statement, otherwise known, of course, as the P&L or profit and loss. The main component parts, revenue minus expense, gives us net income or net loss. Statement of retained earnings. Beginning retained earnings plus net income or minus the loss minus dividend or distribution gives us ending retained earnings. The balance sheet, pretty straightforward. Balance sheet, assets equal liabilities plus owner's equity. And then the statement of cash flows. 2 methods, but 3 categories in the statement of cash flows. The 3 categories or areas of the statement of cash flows: cash flow from operating, cash flow from investing, and cash flow from financing. In operating, investing, and financing. Now, this is just a brief review of the 4 financial statements. In the statement of cash flows, 2 methods. The direct method is where in the operating activity, the first of the 3, operating, investing, and financing, basically there is an adjustment or conversion from accrual-based income, net income, to cash-based. On the indirect method, or in the indirect method, we would start with the net income and add and or subtract the changes cash-wise for current assets and current liabilities. Current assets, current liabilities. Now, the example we're going to see on the next slide is from the direct method. The direct method, okay. Now, for whatever it's worth, we're going to see a cash flow statement later on in the session that's really a modified version of the direct method of the statement of cash flows. Most CPAs, if you're a CPA or most CPAs, I find that the indirect method is generally a little easier to do, a little more straightforward. But we're going to see the direct method down below or in the next slide because we're going to use that in our spreadsheet later on in the session. Let's move forward now to page number 4. Page number 4, Simpson Company, statement of cash flows. Now you can see, and I've underlined these, the 3 major cash flow activities. Cash flow from operating, cash flow from investing, and cash flow from financing. Operating, the normal sources and uses of cash from the regular operation of the business. Investing, the sources and uses of cash by either buying and or selling fixed assets. The third category, cash flow from financing, would be the sources and uses of cash from the debt and equity of the business. Okay, now let's look at the top one, the first one. Pardon me, operating. Cash received from customers, $10,400, source of cash. Cash paid out, rent, telephone, utilities, so forth, use of cash, pretty straightforward. Under the second category, investing. They purchased equipment for $1,680. Well, that's an outlay or use of cash, so we bracket it. If they had sold equipment for $1,680, it would be a positive cash impact on the statement of cash flows or source of cash. Under the third category, the financing. Investment by stockholders, that's equity infusion, $60,000, positive number. Of course, then they paid themselves later in the period a dividend for $1,200, an outlay of cash or use of cash. What if they obtained a bank loan? If they obtained a bank loan for $100,000, it would be a source of cash under the financing activity. And then when they paid back, say, the principal and the interest would be uses of cash. You can see in this example, brand new business started out with zero cash balance, May 1st at the bottom of the page. Then, of course, the cash activity of the three areas combined generates, of course, or shows an ending cash balance $61,140, which must balance to the cash position of the balance sheet. Technically, it is the cash or the bank reconciled position of cash on the balance sheet. Moving forward. Now, just briefly on the accounting cycle. We don't just, of course, obtain all four financial statements just out of thin air, but there's a 10-step cycle. Business transactions, you can see all the way down to the post-closing trial balance, step 10, step 1 to step 10. I would highlight or circle step number 7. Step number 7 is where we actually obtain the financial statements, the four financial statements we've just briefly reviewed. Steps 8, 9, and 10 is simply to close out the books and prepare for the next accounting period. But steps 1 through 6 get us, or we arrive then, of course, at step number 7. Moving forward, page number 6. Some in-depth, more in-depth issues related to income statement and the balance sheet. We'll see in a moment. Of the four financial statements, most credit analysts, loan officers, most CFOs, maybe an analyst, maybe a financial analyst within a corporate setting, most credit managers will look at primarily, once again, the income statement and the balance sheet of the four. So we'll start with the income statement. Revenue and expense recognition. Now, as I mentioned just briefly, accrual versus cash basis. What is accrual based? You may remember this from your accounting days. Of course, if you are an accountant, bear with me in this. We recognize the revenue in the period in which it is earned. We recognize the expense in the period in which it is incurred, irregardless of cash coming to us or leaving us. Cash coming to us or leaving us, meaning the company. accrual-based. We only recognize the revenue in the period in which it's earned. We recognize expense in the period in which it's incurred, irregardless of cash in or out, if you will. Irregardless of those. Okay, now, the cash basis is really a totally different area or emphasis. The cash basis, we would only recognize the revenue in the period the company receives cash, and we would only recognize the expense in the period in which the company expenses or dish out the cash. Cash in versus cash out. That's true cash basis, if you will. Okay. Then moving on to inventory. FIFO, LIFO, average cost. You may remember this from your accounting days. FIFO, first in, first out. LIFO, last in, first out. The FIFO flows, the cost of the inventory will flow through the income statement, cost of goods sold, based upon essentially the normal flow of the inventory, meaning the company buys the inventory, brings it into the model, expenses it out or cost it out, sells the inventory. LIFO, on the other hand, is really totally different. LIFO is where the accountant will artificially show the cost of the inventory for the last purchases of inventory during the accounting period as if it's the first inventory sold. Last in, first out. It's a play on the numbers. If inventory costs have risen during the period, it will create a lower it will create a higher cost of goods sold, lower gross profit margin, and lower net profit margin for the business. Average is the average. What about operating expenses, repairs versus improvements? You can see repairs, we basically just expense those out. Improvements, capital improvements, is where the company actually would not just do a simple repair, but they would add dollars, say, for example, to their building. If they simply do a repair to the roof, they would typically expense those dollars. If they actually replace the entire roof, say for $100,000 or $200,000, they would have to take those dollars and depreciate or recapitalize those dollars as an improvement. And what they would essentially do is redo their depreciation of the actual dollars, or combine that $100,000 to $200,000 to the cost basis of their building and redo their depreciation schedule. Part C could have a major impact either way on the books. That's from an income statement standpoint, especially if they construe, well, it's not really a full replacement. We simply did what? We just repaired the roof and expensed the entire $100,000 or $200,000 off. That's a major difference than an improvement. Let's go to depreciation. For the books or the financial statements, otherwise known as the books of the business, we can use straight line, units of production or activity, double declining balance. Straight line is the most common. You depreciate a delivery vehicle, like a delivery van. $10,000, you bought this used van for $10,000, depreciated over 5 years, it's $2,000 a year. Less any, of course, salvage or residual value. Units of production or activity would be based upon the actual usage of the van. How many miles driven per year? Because the depreciation would be calculated on a per mile basis. Double declining balance is simply 2 times the straight line. 2 times straight line. Most businesses, by far, especially your small to medium-sized businesses that you may deal with, use straight line, straightforward. straight line depreciation. It's a straightforward model. What about for tax purposes? Typically, we would look at, or the company would look at MACRS. MACRS stands for Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. Which, for example, if you're going to depreciate the delivery van, is the 5 years. On a book basis, 5 years. On the tax, 5 years as well. What's Section 179? That's a special provision within the tax code that allows your customer to write off the asset in one swoop, in 1 year. Now, up until 2000, year-end 17, it was around 500,000, 530, 510, I think 510,000. Year-end, this is for tax purposes. With the new tax update, known as the TCJA, Tax Cuts Jobs Act. The Tax Cuts Jobs Act, which was signed into law December 22nd of 17 by President Trump. The Section 179, pardon me, is now $1 million. It's not 510. It's $1 million. Now, there's a third area of depreciation, potentially, in the tax code from a tax standpoint. And, of course, all of these can impact your net income, potentially. How quickly, from a tax standpoint, does your borrower or your customer write off the equipment through depreciation? 50% bonus depreciation is what the system used to be, which means after you take Section 179, you take another 50%. Then you would take MACRS, actually in that order. Section 179, 500,000, 510. Then you take 50%, whatever's left 50%, then the MACRS would kick in. Well, slash through the 50% in your material there, in your PowerPoint presentation, your printout. It's now 100% per the new tax update. 100% bonus depreciation. Also, it used to be the special bonus depreciation was only for new equipment. Now it can also be used equipment. Kind of interesting. Let's move on to amortization and depletion. Well, back up to the depreciation, we depreciate vehicles, equipment, and buildings. Amortization is like depreciation, but it's for an intangible asset, such as a copyright, a trademark, a patent, goodwill, something of that nature. Depletion is like depreciation, but it's for a natural resource, such as timber, oil, gold, natural gas. Now, we're going to see this momentarily in several of our cash flow models. The depreciation expense, amortization expense, and depletion expense are generally added back into cash flow, which we'll see momentarily. Why? Well, because from an accounting perspective, generally they are considered non-cash expenditures. We'll come back to that later on. Page number 7. On the balance sheet, shifting down to the balance sheet, these two of the 4 income statement and balance sheet, most common. Under Part A, receivables, accounts receivables. Under Part A, the aging. You would, of course, obtain the AR aging report, which shows 0 to 30 days, 31 to 60, 61 to 90, over 90. And I'd like to have you highlight or circle Part 2. This little phrase off to the right in the brackets. When you look at your client, whether you're a lender or whatever capacity you are in, when you look at this, we really should think in terms of our customer's ability as a lender. Now that sounds strange. If you happen to be a commercial lender and you provide a line of credit to your customer and you secure the line with a UCC filing on receivables, well, you're the lender to your customer, but wait a minute. What are you really ultimately lending on? Your customer's ability as a lender and as a collector, almost like you are to them. Why? Because those receivables are essentially their loans to their customers. It's amazing. If you think of it in that perspective, it takes on a whole new idea of looking at the AR aging report and the individual receivables. Let's go to part B. Most of your customers, if they're small to medium-sized privately held firms, I add this to your notes off to the side of part B. Direct charge-off method or write-off method. From an accounting perspective, most of your clients will just wait till the receivable is dead and then they charge it off. The more sophisticated method is the allowance for doubtful account, where the company pre-reserves for future losses. Once again, most, by far, the vast majority, privately held businesses in America, even some sizable ones, do not use the more sophisticated allowance. They use the less sophisticated, well, we just wait till the receivables dead and then we charge it off. Direct write-off. A lot of times you'll see in the aging report, there's actually receivables that I like to call, from a slang term, sleepers, sleeper receivables, or sleeper cell, almost like a spy movie. You know, sleeper cell like a spy. You know, lives in the community for 25 years. People don't realize it's a spy. That person's a spy. Well, the same way with receivables. You think they're healthy, and they're not. And then all of a sudden the company charges it off. Whoa, wait a minute, what happened? Moving back to the allowance. Two ways to physically calculate the doubtful accounts, the allowance, this reserve. Percentage of sales and percentage of receivables. Percentage of sales is, well, we've always charged off about 1% of our credit sales. Well, okay, so we'll reserve about 1% and build this allowance or reserve account by 1% or 2%, whatever the number is. Percentage of receivables would be, okay, 0 to 30 days, 31 to 60, 61 to 90, over 90. The further the receivable is stretched out, the more we reserve. Under Part C, accounts payable. Shifting now. Timing, COD. Wait a minute. Timing is everything, both receivables and payables. Well, if we're going to stretch out on the receivables, we've got to stretch our payables out or we're going to get caught in the middle, meaning the company will. So timing is everything on both sides. COD, cash on demand, cash on delivery. I'd add this to your notes off to the side of Part C, please. It's the old adage. We typically, as a company, want to slow our payables just enough that we do not get put on COD. Kind of push the limit, not too much, not to where we get put on COD. But if we push it, it's going to help us financially. It's going to help our cash flow financially. Why? Because we're delaying our payments. We're retaining, from a timing standpoint, our cash. Under Part D, on the balance sheet, capital versus operating leases. Capital lease is a long-term lease similar to a long-term loan on a piece of equipment, as an example. The capital lease shows up, the equipment shows up on the asset side of the balance sheet, and the capital lease shows up as a liability on the liability side, like almost as if it's a long-term loan. Same category, essentially. Whereas an operating lease is more short-term. Well, the company will rent a backhoe, or a piece of equipment or something for a week or 2 weeks. They'll just expense that off through the income statement. But if they really, essentially, they don't own the equipment on a lease, capital lease, but essentially they do. The last payment, they own it. Well, they're going to show it on their balance sheet. Moving forward, page number 8, a little bit more, if you will, on the balance sheet. Equity section. If you have a C Corp, most of you don't even really deal with many C Corps unless you're dealing with big publicly traded corporations. But if you're dealing with a C Corp, there can be common, there can be preferred stock. Preferred stock, well, it's like the lords and ladies versus the commoners, if you will, in Old England. What's the preferred? They're preferred in 2 ways. I'd add this to your notes. Number 1, preferred stock, if there's only so much cash to be paid out in the form of a dividend, preferred gets paid first. If there's number 1. Number 2, if there's a liquidation of the company, preferred stockholders get paid first, and then common. But what does common have? They get the general vote in really managing from a strategic or large, big picture from a, say, board of directors, what have you. They get the vote. And even the common shareholders that are not on the board, they can vote their proxy. They can vote the decision. So the commoners don't have, just to clarify, commoners are not in a position of having no benefits, no rights. They have major rights in the vote, such as a proxy vote. They even can vote who's going to be on the board. Kick someone off the board, put someone else on the board of directors. S Corp. If you have an S Corp and there's only one class of stock, that's a common stock. If you have an LLC partnership, it's a capital account. If you happen to be a lender, most of your borrowers today are LLCs or S Corps. Very few today of small to medium-sized privately held businesses are C Corps. A few other related items when we move forward. Under number 4, just briefly, what's treasury stock? Treasury stock is when typically a publicly traded corporation, it could be privately held, but typically we would see this in a publicly traded corporation, will take their cash and buy their own stock back and hold the stock. And then 6 months, 9 months later, in the market price of the stock rises, and they sell their stock to make money. It's called treasury stock. The reason why it's called treasury stock is hundreds of years ago, the company would hold the physical, even 100 years ago or even less maybe, they would hold the physical shares of stock in their treasury or their vault. That's where the term comes from. Let's a stock split. Say, for example, a two-for-one stock split. You send out a notice to your shareholders. This one shareholder, Sue, she owns 1 share of stock worth $10. The company sends her a notice, we're going to give you 2 shares worth $5 a piece, $10. Why did they do it? Well, because the company has some major announcements, positive financial announcements up just over the next couple of months. Typically those 2 shares at $5 a piece will all of a sudden go to 10 or 15 overnight. Now all of a sudden Sue's doubled or even tripled her investment. And it gets the stock momentum moving forward. 2 for 1, 2 shares for 1. They don't just do it just to let it sit there. There's a strategy behind it. What about retained earnings? Retained earnings are the equity of the business. I've put off to the side of Part C, 4C, restrictions. If you're dealing with a big publicly traded corporation or even, even some other, like a municipality even, in the retained earnings or the equity section of the balance sheet, you'll sometimes see restricted. And the reason why is it may be restricted because of a bond issue or what have you. And it really restricts the equity, which is really restricting, to a degree, the company's cash on the flip side of the balance sheet under the assets. Because it says, well, we're going to restrict a certain amount of your equity moving forward. Page number 9. Now, types of financial statements. And let's go down to part B3. We've talked about the 4 types of financial statements. This is the level of reporting or the level of sophistication of the 4 financial statements. We'll start with B3 at the bottom. Company prepared. I'd put in your notes off to the side, QuickBooks. QuickBooks. What's QuickBooks? Well, it's the most common accounting software for small to medium-sized businesses in America today. Sometimes I will hear commercial lenders, as I go all over the country. I was just yesterday in the upper Midwest of the country, just yesterday in a ground-based session. Sometimes I'll hear lenders specifically kind of snicker, like, well, QuickBooks is kind of low-level accounting software. But that's a misnomer. It's actually state-of-the-art. QuickBooks is state-of-the-art. Most CPAs are very in tune with QuickBooks. It's not the software that the issue is at hand. It's who is managing the software. The controller, the bookkeeper, the accounting staff. But what is a company prepared financial? It's just company prepared. Generally considered not that high level. Even though the QuickBooks is not the culprit, it's the individuals, once again, managing the QuickBooks. Let's go up to B2, go up to compilation or compiled. Compilation or compiled financial statement is basically the CPA takes the QuickBooks, puts it into their format, puts a big disclaimer. Well, this is management's information, responsibility. But generally, most people would say CPA compiles a little higher level, sophistication. How about reviewed? Reviewed, even higher level. Higher level is where this CPA reviewed, or higher level under B1, is where the CPA does review the books, goes out to the company, camps out for a couple of days in the conference room, reviews the books per GAAP, generally accepted accounting principles, GAAP or GAAP. Now let's go to the top, to the audit. Under Part A, or off to the right of Part A, audit. An audit is a full review of the books, kind of like B1 down below. But there's also confirmation letters that are sent out to the bank on the deposit, on the loan side, to the customers on the receivables, on the payables, the suppliers on the payables, the customers on the receivables, to verify the dollar amounts as of 12/31/17. There's also confirmation letters sent out to the attorneys or attorney related to any legal matters related to the company. Now for the levels of an audit. Unqualified audit, off to the side of that, I'd put in your notes, please, the word clean. It's a clean audit. Doesn't mean it's perfect, but the books are kept per GAAP. It's clean. The confirmations are clean. What's qualified? The next level down. Everything's clean, but maybe 1 or 2 violations of GAAP. 1 or 2 violations. What is adverse? Multiple violations of GAAP. Multiple. What's a disclaimer, number 4? I put in your notes the word run. The books are so messed up that the CPA cannot and will not issue an opinion. I just put the word run the other way. Now, before we leave this page, look at the bottom under Part C. Related concept. Not with company prepared, even not with compiled usually, but with reviewed and with audit, definitely. You'll have notes at the back of the financial statements, of course. Note number 1 through 20, 1 through 18, or what have you. The notes in theory clarify the various component parts of the financial statements. But I would add this to your notes. Be aware. Be aware. Sometimes the notes are very confusing, and the verbiage or terminology can be confusing. So please, at the bottom of this page, off to the side of Part C, Notes to the Financial Statements, I'd add this to your material there. Don't be afraid to ask questions, especially if some of the notes are very confusing. Hey, CPA, I need a clarification. Hey, CFO of the company, controller, owner of the company, can you clarify note number 3, note number 13, note number 15, whatever the note is. Moving forward, please. Page number 10. Now that we've done our accounting side of the financial statements, now we're going to do the analysis side. Now, the two tie together. The accounting side is really better understanding what you're looking at from an accounting perspective. Now, if you're a lender, I find this to be very true. Oftentimes, we miss the first part of our webinar today. We don't look at the numbers from a financial statement perspective enough. We jump right to taking the numbers, what we're going to do momentarily, and do some key ratios, cash flow modeling, and so forth. We don't spend enough time in assessing the quality, for lack of a better word, of the financial statements like we did in our first part of our session today. I would beg of you to consider to add to your time in analyzing the financial statements, looking at the financials from an accounting perspective up front, and then move to page 10 and forward. Okay. Now, having said that, let's go into this next section. Who uses the financial statements? Well, you can see creditor, investor, management, guarantor. Creditor, I'd circle off to the right of creditor at the top of page 10 here. Bank loan officers and bond rating analyst. Well, you may be a loan officer. You may be a bond rating analyst. Needless to say, we look at cash flow primarily, but we also look at some of the other key ratios. Under investor, I'd circle stock analyst to the right. They look at the numbers a little differently. Under management, I'd circle both business owners and managers. And right above business owners, I would put the letter P, and right above managers, I'd put the letter A. The owner of the business is the P, the principal or owner. The manager, like the CFO or the general manager or the COO or the controller or whoever, is the manager. In a small business, they're one and the same. Larger customer or client you may have, they're obviously much larger. They're much larger, and therefore the two different roles. There's oftentimes principal-agent conflict in really interpreting the numbers. Keep that in mind as we go through some of these calculations in just a moment. Lastly, under guarantor, I would circle related analysis. If you're dealing with a small to medium-sized privately held business, which I suspect most of you deal with, well, if we don't look at the personal side of the business owner, we miss half the story, so to speak. Now let's turn to page number 11. And we're going to look at a 5-step model called the Laylock model. If you take your highlighter or your pen, you can highlight the first letter of each one of these categories. L for liquidity, A for activity, and so forth. Laylock, L-A-L-O-C. What is liquidity? Off to the side, I put in your notes, liquidity, the nearest to cash. The nearest to cash. Activity, turn factors. We're going to specifically look at AR, AP, and inventory turnover. AR, AP, and inventory turnover. Leverage. Leverage is the company's ability to service long-term obligations, long-term obligations, more than a year. Operating performance, number 4, the O, profitability, the profitability of the business. And part E, cash flow, cash in versus cash out, cash in versus cash out. I like to call it the lifeblood of the business. Each one of these steps are important to analyze so we get a really good feel for this operating business. But if you looked at all 5 of these and said, well, which is number 1? It's cash flow. So we will cover several different cash flow models momentarily. Let's move to page number 12. Page number 12, Snyder Corporation. You can see on page number 12 and also on page number 13. You can see we have both the balance sheets and the income statements. Also on the bottom of page 13, we have, of course, the industry average. You'll notice 17 has an E estimated. Because we're now in 2018, I'd slashed through the E on both the balance sheets and the income statements. Take just a moment and review page number 12 and page number 13, just to kind of get a feel for the numbers, if you will. Take just a moment and do so, please. Okay, balance sheets, income statements, Snyder Corporation. It's simply just before we go forward, if you will, just to clarify. This is a small manufacturing firm. If you'll turn with me, you can see page 12, page 13, and then, of course, page 14. We talked about liquidity briefly. 3 main calculations that you would look at. Working capital, current ratio, quick ratio, or asset test. You can see the formula. It's pretty straightforward. In order to save some time, I'm going to give you the calculations for Snyder Corporation. You can jot these down in your booklet if you would, or your material. So you've got a reference. You could even go back and grab your calculator, run the numbers, and or your Excel spreadsheet. Working capital for 2015, and we'll do 15, 16, 17 all the way through. For 15, $642,400. $642,400. 2016, $617,842. $617,842. For 17, 2017 year end, $1,640,312. $1,640,312. Now for the current ratio, all 3 years, 2.33, 1.46, and 2.58. 2.33, 1.46, and 2.58. Quicker asset test, 0.85, 0.50, and 0.93. Pardon me, 0.85, 0.50, and 0.93 for the quicker asset test. Now, how would you interpret the strength or weakness, liquidity of Snyder Corporation, this small manufacturing firm? Well, before we say that, let's go back just a page and look at the industry standard at the bottom of the page. You notice the current ratio of 2.7 and the quick of 1.0. Well, if you go back forward, just go forward back to the little chart we filled in. You can see and I would add this to your notes. This is true for all of these calculations we're going to look at for Snyder Corporation. 2 general rules of thumb. Number 1, self to self, and number 2, self to industry. Self to self meaning the trend, year to year to year of the company versus self to industry. Well, we know the industry comparison, we know the self to self, I gave you those, and we know the industry comparison of 2 of the 3. Working capital traditionally we don't have. Well, self to self, the numbers kind of bounced around for the current ratio. 2.33 down to 1.46 up to 2.58, but still below 2.7. And the quicker asset test, 0.85 down to 0.5 up to 0.93, still below the 1. I would say on the weak side, if you were using one of 3 words, strong, moderate, or weak, my personal opinion would be on the weak side. Okay. Those 2 general rules of thumb are huge in analyzing the numbers. Before we leave liquidity and go into the related concepts, off to the left of A2, old-fashioned rule of thumb for a minimum current ratio is a 2.0. Old-fashioned rule of thumb for the quicker asset test to the left of number 3, I would put as a 1.0. Well, that kind of gives you even further basis to make the judgment call. Some people would say, well, not weak, but maybe weak to moderate, trending a little better, especially that last year, which I agree. Now let's look at the related concepts. We talked about accrual versus cash basis already. That can impact the liquidity or the true version or interpretation of the company's liquid asset position. Here's another idea under Part 2 at the bottom. Prepaid expenses. Prepaid expense is by definition, by GAAP, is a current asset like prepaid insurance, rent, and so forth. But most individuals realize it will never convert. Those dollars will never convert to cash. So most analysts in these related or higher level concepts, 1, 2, and 3, they will throw out prepaid expenses out of current assets. Did they violate GAAP? Absolutely. But remember, they're not preparing the financial statements, they're analyzing the financial statements. The next category, under Part 2 off to the right, due from officers, shareholders, and employees, we would exclude those from the current assets, which of course would impact all 3 calculations up above. Why? Why do we do it? Well, oftentimes, the owner of the company owes money to the company. They don't pay it back. It's my company. Employees, there's loans to employees, employee loans, considered as a receivable, as a current asset. Well, oftentimes those are defaulted on. We cannot rely upon those dollars, so we exclude them or adjust them out. What about contingent liabilities? For either the business and or the owner of Snyder Corporation. Let's say that Snyder Corporation is owned by Bob and Sue Snyder. Bob and Sue Snyder, well, they may guarantee millions of dollars that we don't know in related or really unrelated debt to the business, but it's a liability. Why? Because they have personally guaranteed it, and they own the business. They get into a bind, they're going to rob Peter to pay Paul, take the cash from Snyder Corporation, bring it over, satisfy their guarantee. And or it could be that Snyder Corporation itself is a guarantor. Wow, even more direct. Page number 15, Model 2. Activity, we said the turn factors. You can see AR, AP, inventory turnover. AR divided by sales times days in the period. Annual financial statement, 365. Accounts payable, Turnover, accounts payable divided by COGS, cost of goods sold times days in the period. Inventory, inventory divided by cost of goods sold times days in the period. Let me give you the numbers for Snyder Corporation for the 3 periods, 15, 16, and 17. And these are rounded numbers. If you'll add this to your notes, AR turn, 37, 40, and 46. 37, 40, and 46. AP turnover, 19, 24, and 23. 19, 24, and 23. Inventory turnover, 91, 94, and 108. 91, 94, and 108. Okay, now, what is happening to AR? Stretched out. What's happening to AP? Ooh, rather stable, but very short. What's happening in inventory? Stretched out. If you look back to page number 13, you will see the industry comparisons for AR and inventory. AR's day sales, 32 days. If you flip back a couple pages. If you look back to page 13, inventory, you'll notice, is 6.1. Well, that's in times per year. So we need to convert the inventory in days to times that I just mentioned. 91 days, 94, and 108. How do you do it? You take, for that first year, for 2015, you take 365 days divided by the 91 days I gave you for inventory turnover. And that will give you 4.0. I'd write that down, 4.0. The next year, 2016, we take 365 days divided by 94, and you should come up with approximately 3.87. 3.87. The third one, I mentioned 108 days on the inventory turnover. How do you make the equivalent of the times per year? Take 365 divided by 108. You should arrive at approximately 3.38 times per year. So what's happening with inventory in days? Stretched out. What's happening in times? Less times. It's the same idea, just looking at it from days versus times per year, times versus days. Now, how would you rate activity for Snyder Corporation overall? The AR stretching, the AP stable, the inventory stretching relative to itself. Self to self, number one. Number two, self to industry as well. Negative trend, major negative trend for two of them. They're getting stretched out. Now let's go to the higher level related concept. It's called the cash conversion cycle. What is cash conversion? Well, if you'll add this to your notes, the definition. Cash conversion is the number of days that our cash is tied up in current assets. The number of days our cash is tied up in current assets. We want cash conversion cycle to shrink preferably over time. Let me give you the cash conversion cycle for the 3 years. Now you can see this. The formula is down below. It's inventory in days plus AR in days minus AP in days from up above. It's that simple formula. The amount of days of inventory turn versus, or pardon me, plus AR turn minus AP turn for the 3 years. 110 rounded, 110 rounded, and 131. 110, 110, and 131. What do you mean by 110? 110 days. 110 days, second year, 131 days stretched out. Not a good trend. How could Snyder Corporation improve? Get a better handle on their inventory turn. Shrink that. Get a better handle on their AR collection. Shrink that. AP, maybe stretch that out a little bit. Stretch it out a little bit. By doing so, mathematically, the cash conversion cycle will shrink over time, which is a good thing for the business. Moving forward, page number 16, model number 3, leverage. We take the total debt or liabilities on the balance sheet divided by the total equity or net worth of the company. Let me give you the 3 calculations. Before I do so, the old-fashioned rule of thumb for this particular key ratio is a maximum of 3.0. On the current and quick ratio earlier under liquidity, the more the merrier. This, the lower is the better. So it's a maximum, not a minimum, but maximum of 3.0. Here's the numbers for the 3 years. 1.21, 4.18, and 0.78 for Snyder Corporation. 1.21, 4.18, and 0.78. And if you look back on page 13, the industry standard is 3.0, or pardon me, 2.0. 2.0. It's a 2.0. Now, why did this company all of a sudden dramatically improve its debt-to-equity ratio? Went from a 4.18 dropped to a 0.78. Well, if you go back with me to page number 13, you see the industry standard debt ratio 2.0 at the bottom. But if you go back to page number 12 to the balance sheet, and look at the bottom right-hand side of the balance sheet under common stock. The Bob and Sue Snyder sold off part of their business. Look at the common stock from 16 to 17, increased by about 1.2 million. They sold off part of the business. They took the money, and primarily, if you look at this bottom part, right-hand side of the balance sheet, they paid down on their debts, which is actually a conservative play. Now, they probably violated or broke their bank loan covenant, but at least they did something conservative appropriately with their dollars. Going back or going forward to page number 16, higher level related concept, subordination of debt. What if Bob and Sue had provided a $200,000 loan personally to the business? We could have them sign a subordination agreement, and that $200,000 is subordinated to you. Say you're the bank. Say you're a banker. Well, mathematically, in the debt-to-equity ratio, what would we do? We would take out the $200,000 from the debt side of the equation and add it to the equity. Because why? Because legally, if everything falls apart, they're behind us, meaning behind the bank. Could dramatically improve this key ratio. Well, essentially, that's what Bob and Sue did when they sold off part of their business. They essentially took the stock or the equity and paid down on the debt. Well, we wouldn't be doing the actual physical pay down of the 200, but mathematically we're eliminating the 200,000 that they lent their business in this example, and we put it over to the equity side of the calculation or key ratio. Moving forward, page number 17, fourth of the 5-step model, operating performance or the margins. We talked about profitability, the margins. You can see we look at the income statement and we put it in percentages. Cost of goods sold, 88% of the 4.4 million divided by the 5 million and so forth. G&A, general administrative expense. The two major calculations that we would look at on this is actually the 12% and the 5%. I would circle the 12 and I would circle the 5%. Gross profit margin and net profit margin, 12 and 5%. But we would look at self-to-self, self-to-industry. We would look at, for example, 3 years plus even an interim financial statement So, for example, today we would look at year-end 15, 16, 17, and 3/31 of 18, of course. Related, higher level concept we've discussed already several times. What's the true profitability? Accrual versus cash basis. Sometimes the accrual basis will kind of have an artificial impact on the numbers, if you will, even for profitability. Recognition of the revenue and expenses, tying those together, ties back to the accrual basis accounting. It's a timing issue, the recognition of either or both of those, revenue and expense. Now for page number 18, our fifth and final of the laylock model. Traditional, EBITDA. What's EBITDA? Earnings before interest, taxes, depreciation, amortization. Earnings before interest, taxes, depreciation, amortization. And we can even add another D to that for depletion, as we discussed in the accounting section up front in our session today, in our webinar today. Add another D, depletion. The inflow is 1.2 million. 1M stands for 1,000, 2M stands for 1,000,000 in Roman numeral system. If you see 1M in the Wall Street Journal, they mean 1,000,000. But that's really a misnomer. That's not correct. That's not correct usage of the letter. 1M is 1,000, 2M is 1,000,000 in Roman numeral system. Just like a V is 5, an X is 10, and so forth. 1.2 million inflow, minus the outflow. 500,000 principal and interest gives us the margin or excess 700,000. 1.2 million inflow divided by the outflow of 500 gives us the DCR or debt coverage ratio, 2.4 times. Some banks, some underwriters, commercial underwriters will call it a DSCR, debt service coverage, same thing. How do you interpret the 2.4? For every $2.40 of inflow, there's a dollar outflow. By the way, you would only have the T added back in if you're dealing with the C Corp. S Corp, LLC, no way, because those are pass-through entities. And the reason why you add a T for the C Corp is the taxes, income taxes for a C Corp are considered non-operating expenses. Non-operating expenses. You can see the minimum DCR or DSCR 1.20. Used to be 1.25. 2-3 years ago, it's dropped. Why? Economy's better. Competition amongst lenders is strong. Page number 19, our second cash flow model. Personal, I mentioned this. We've got to look at Bob and Sue personally. This is based off their tax return. 1 year to illustrate, but in reality, we would have 15, 16, and 17 year ends. All these cash flow models, all of these models, we would want at least 3 years. But just to keep the numbers light, you'll notice a lot of these I've just shown 1 year. The inflow, salary, business income, rental, K1 pass-through, 500,000. We then subtract off taxes. I put right below the word state the number 9. If you're dealing with Texas, if you're dealing or Florida, those are 2 of the 9 states have no state income tax, so you would eliminate that. It wouldn't be there. All the other states, you'd have federal and state. 500 minus 150, of course, gives us cash flow available for debt service, 350. Minus the debt service for just Bob and Sue personally, 200,000, gives us 150. We take the 350 divided by the 200, gives us the 1.75 coverage. And you can see the standard down below. Although most banks today and most other underwriters, commercial underwriters, will use a 1.2 even on the personal. But it could vary. It could be a little bit of a range. Now, before we leave this model, in the last 2 or 3 years, the federal, for whatever it's worth, the federal bank examiners insist that the underwriters include what's called a living allowance for the personal cash flow of the business owner. And this would be found right under debt service, so it's additional cash outlay. How do you physically or mathematically calculate it? If you look at the $350,000 times most banks, this is the most common I see nationwide, times that 350 times 25 or 35%, 25 or 35%. And whatever that raw number is, it's what's tucked in right below debt service as an additional outlay of cash. Page number 20, our third and final of the main cash flow models for today's session. Global has nothing to do with international trade or banking or anything. It's simply just a combination of the two models we've just covered, business and personal. You'll notice the combined margin, combined DCR at the bottom. I put this in your notes, please. This has also become mandatory in the last few years by the regulators. And number one, number two, most institutions, as a minimum standard, 1.20, debt coverage, 1.20. Now, if you'll move with me to page number 21 and now into our spreadsheet. Instead of manually doing all these calculations, the analyst would do what? Load the balance sheets that you can see. This is a different case study, by the way. This is sample contractor. Here on page number 1 of the spreadsheet. It's called Moody's spreadsheet. Load the balance sheets. Page number 2, if you turn forward, page 2 of the spreadsheet, page number 23 within the actual PowerPoint slides. Income statements. These are loaded or spread on from the financial statements as prepared by the accountant and put into the specialized spreadsheet, instead of manually calculating all the numbers, like we went through many of the formulas. Page number 24 is where we common size, or really step number 4 of the Laylock model, the operating performance. You'll notice the raw numbers of the income statement and then the percentages, including the gross profit and the net profit margin. Gross profit and net profit margin. Page number 4 of the spreadsheet, page 20 of the PowerPoint, is the UCA cash flow. Top left-hand side of this page, you'll see the title UCA, stands for Uniform Credit Analysis Cash Flow. Uniform Credit Analysis Cash Flow. Sources and uses of cash. You notice the first year, 2009, 906,000 positive revenue, that's a source of cash. This is at 2009, right at the top middle of the report. The very next line down, change in accounts receivable, positive 9. That means receivables actually dropped, which is a source of cash. The next year, you'll notice 50,000. The next period, a negative 16. Drop down about 2 categories down to where it says change in accounts payable subcontractors. Look what sample contractor did. Small little general contracting company. That first period, they leaned on their subcontractors. 55,000 on their payables increase. That's a source of cash. Like we discussed, similar to what we discussed earlier. Over to the right, 5 and 3, not as bad. Well, what was the worst year of the Great Recession? 09, typically in most markets. 09, 10, somewhere in that range. Some markets a little earlier. In this particular company, 09 was the worst year of the Great Recession. Go down to the middle of this page where it says net cash after operations. That's the true cash after the operations of the business. That big black line in the middle, I'd highlight that. We'll come back to this concept in just a few minutes. If you turn with me now to page number 26. Page number 26 is the key ratio page, or summarizing all of the Laylock model. You can see at the top left-hand side we have liquidity, model 1. 2/3 of the way down, you can see activity model 2. Go back towards the top, you can see the word leverage model 3. The middle of this page, you can see the word profitability model 4. And just above profitability, you'll see cash flow model number 5. Now, to simplify this particular key ratio analysis, if you'll turn with me to page number 27. Page number 27 is a summation of the Laylock model that I pulled off of the previous page or the last page of the spreadsheet. You'll also notice I've added what's called the RMA comparison or Risk Management Association or industry study. Used to be called Robert Morrison Associates. Today, it's called Risk Management. Kept the acronym, changed the name. So here we can see self-to-self and self-to-industry. Moving forward. If you will turn with me back one page to the last page of the spreadsheet, towards the bottom of the page on the left, you'll see under activity Z-score. If you'll highlight that, including the numbers, and then sustainable growth in the very bottom of this page. We're going to go ahead and cover those momentarily. If you'll turn forward with me to this next page, past my summary page for sample contractor, we're going to talk about the Z-score. Now, they show up in the spreadsheet, which is nice. It's convenient because we don't have to calculate it. But what is the Z-score? It predicts bankruptcy. You'll notice on the second paragraph, it's actually named the Altman Z-score. If you Google it, don't Google Z-score because you'll get the old Z-score from your stats class, statistics class back in your college days. But if you Google Altman Z-score, you'll get this. Here you'll see in the middle of the page an actual formula. Now let's move forward to the next page, page number 29. Page number 29 is simply the numbers from that last page of the spreadsheet, the Moody spreadsheet from 2 pages back that I had you highlight. You'll notice the first year, 2.92, second year, boy, negative. Third year, they moved totally the other direction, over 8, and the last year, almost 8. Look at the scale down below. This is the key to the Z-score. If you have a Z-score that's over 3, companies far from bankruptcy. 1.81 to 3, gray zone. 0 to 1.8, I call it the death zone. That's my made-up term. Meaning if a company's in that zone, like this company was in 2009, if they don't do anything proactive management, they will file BK someday, soon. Usually within no more, I should say, than 6 to 9 months, and usually even less than 6. This is powerful. What if you don't have a Moody spreadsheet or this type of software, which is quite expensive? Last time I checked, like $4,000 per station plus. You can Google Altman Z-score. Get a not pre-calculated, but pre-formatted Excel spreadsheet. You would still have to going back one page to page 28, pardon me, you would still have to go in and look at or plug in the variables, as you can see on the bottom left-hand side of page 28, but you can do it. Moving forward, last major model from our spreadsheet. Then we just got a few little items and we'll conclude our session. Sustainable growth. If you'll highlight the middle paragraph where it says, in order to grow faster, that small little paragraph in the middle of this page. This is a kind of a what-if scenario that says, well, what would the numbers look like for this company? Meaning from a sales growth perspective, if this company had no additional equity or no additional debt capital coming into the business or no improvement in its profit margins, No additional equity capital coming from outside. No additional debt capital coming from outside the business or any improvement to its profit margins. Now, if you'll turn with me to page 31, these numbers came right off the Moody's spreadsheet I had you highlight on the bottom of that last page, just a few pages back. You'll notice it says basically the company could grow that first year 108% in sales. Next year, 63, but then eventually it slows down. Companies, even large companies, small and large, even a Walmart cannot grow financially on its own traditionally. It must have debt and equity. Walmart will continuously issue new stock equity, new bonds, debt to finance its growth pattern. Same concept with this small little general contractor, sample contractor. Of these two advanced models, Z-score and sustainable growth, Z-score, in my opinion, the most applicable, really most important. I'm not saying this is not a good model to look at, but as far as a big picture of the health or weakness of your client, Z-score all the way, in my opinion. Now moving forward, just a few little cash flow models and we'll conclude. Cash basis cash flow. I mentioned the NCAO, or net cash after operations. That's the inflow to this model. That started from the UCA cash flow in the spreadsheet. The true net cash after operations. In this example, $800,000. 3 outlays of cash: mandatory capital expenditures, dividend distributions, and the debt service. Those 3 outlays, $750,000. 800 minus 750 gives us 50. 800 divided by 750 gives us 1.07. For every $1.07 of inflow of true cash, there's an outlay of $1. No minimum standard on this particular model, by the way. But most underwriters would like to at least see a 1.0. By the way, where do you get the mandatory capital expenditure? The customer. Well, this is roughly what we need in equipment, vehicles, so forth, to grow the business this next year. Page number 33, fixed charge coverage. Similar to the EBITDA formula we covered earlier. In the numerator, EBITDA, but then we subtract off the cash distributions and tax payments, or taxes. In the numerator, we have the current portion of long-term debt, which is principal, plus the interest expense, or P&I. What's the PP? Prior period. Because the CPA prepares the current portion of long-term debt, as of year-end, say 12/31 of 17, but when is it paid out? In 18. In 18. So we have to stagger the prior period. For example, if we were going to do a 15, 16, and 17 cash flow model, we would use year-end 14, 15, and 16 for the current portion of long-term debt. Why? Because respectfully, they're paid out the next year. We would use the 15, 16, and 17 actual interest expense for those years. Free cash flow. Free cash flow, and add this to your notes, is primarily used for large publicly traded corporations. The inflow, as you can see at the bottom, NOPAT, net operating profit after tax. NOPAT, net operating profit after tax minus the operating capital. This model is really not applicable to most small businesses, even mid-sized businesses. Why? Because it's usually a negative. But large publicly traded corporations, very applicable. Moving on to our last cash flow analysis, and we'll conclude the session. Sensitivity analysis. This is huge. I beg of you to consider adopting this format or some variation of it in your cash flow modeling to really understand the financial position of your client. Over to the left, you can see we have the start of the 6 columns. Steady state is the first column. It's basically the company just by itself. Look down below, if you would, and you'll see the 2.86 coverage. Look to the next column, the steady state with the new loan request. Look what happens to the debt coverage, drops it down to 2.13 at the bottom of the column number 2. Column number 3, a 10% drop in sales. Look at the bottom of that, 1.31. Look at the fourth column. That's a huge hit, by the way, drop in sales. Fourth column, drop in income, not that bad, a 1.95 at the very bottom. The fifth column over, 2% rise in interest rates. Most banks, most lenders are very concerned with rising rates, but it doesn't really impact the cash flow that much, 2.05 at the bottom. Now for the sixth column, the income shock or break even. You'll notice 0.99. I'd slash through that at the bottom of this sixth column, put 1.0. It's just a rounding error in the Excel spreadsheet. And I know it's cut off from the bottom, but you can look at that sixth column, and basically it tells us the company could drop in its cash flow about a little over $1.3 million. I'd write this at the bottom if it's cut off on your page. If it's cut off on your page, it's 1.3 million or 54% drop in the company's cash flow, and it still can break even, including the new debt service, of course. This is a very powerful model, in my opinion. With that, if you'll turn with me to our last page, and we'll conclude the session. This last little model here on page number 35 is simply some thought beyond the typical financial statement analysis. For example, under A, what if your company you're analyzing only has one key customer? Wow, there's risk beyond the numbers. Under Part B, one key product. Under Part C, you can see to the far right, one single supplier. What about Part D, overseas sales, business? Under Part E, I would circle or highlight the word competition. Under Part F, what about future prospects? And lastly, under this last one, Part G, legal and regulatory environment. This is huge to consider. These factors on this page, on this last model, page 35, looking beyond the numbers, you can't measure these in the numbers until they impact the numbers. But they are definitely, in my opinion, items to consider beyond the numbers. To really get a handle, where is my client going? Where are they at today? Where are they going into the future? With that, I'd like to thank each of you for attending today's session. I'm going to turn the time back to our administrator to see if there are any questions and to conclude the session today. Go ahead if you would, please. If there's any questions that come through during the session, I'd be glad to answer them at this time.